Hey and welcome to this video. So in this particular episode, the continuation of where I left off on Fibonacci retracement, I'll be explaining the concept of higher high and higher low. Now, we've had about 20 videos before now, but I deliberately avoided the concept of higher high and higher low because it actually takes considerable time to learn, or it took me time to learn rather. So I was looking for a way to make it simpler. So if you're someone like me, I found an alternative even before I learned the concept of higher low. I explained to myself in a better way or in a way that I understood. But for you to get it with Fibonacci retracement, I'll try to make the explanation as simple as I can make it. Now, for a general market is either trending up or down. But we know that market does not go up or down forever. There are slight corrections in prices that momentarily turn price from one direction. Uh, it makes it look as though price is going in one direction or changes direction to another side, but ultimately it goes in the predestined direction, if I can put it that way. So those small corrections are called retracements. But another way to put it is price making highs and lows. Fundamentally, a market that is trending up is a higher market, and a market that is trending low is a lower market. Okay, have that at the back of your mind, and it's going to make your understanding better. A market that is trending up is a higher market, and a market that is trending low is a lower market. Let's start with the higher market. Market does not go high forever. Okay, so when it starts, let's start from this point. Market is going high. Now, when it got to this point, market made a small correction back. So let's bring out our support and resistance to. So we start from this point, and when it got to this place, we can say market made a higher high to this point. Okay, and then this point was a higher low. Remember, a market that is generally trending up is a higher. So when it goes up, it's a higher high, and then when it makes a slight correction back, it's a higher low. Now the next move is another higher high. Now, if you take note, this higher high has taken out the previous higher high. So we have a new higher high at this point. And then this came down to, this was a higher low. It almost took out this higher low before, but they are on the same angle. So this is another higher low. Now the next move is going to be higher than the previous higher high. So this is another higher high that's taken out the previous higher high, and when it made a small correction back is another higher low. And then when it moves out again with this leg just broke out of this structure. This is a new higher high. All right, and then it made a correction back, another higher low, and then the leg is going to move out again. This is higher high, and then it made a correction back. We did not take out the previous higher low. This is higher low, and then we went back up higher high. Then it came back to this higher low. Okay, then market has stopped getting to this higher high. So this is an indication that market is probably going to change. So the market is not forming higher highs and higher lows again at this point, because they seem to be on the same level but not as high as the previous higher highs. And then ultimately it was able to break down the higher low into a new structure. All right, so let me recap again, or do a brief recap again. Market that is trending up is generally in an uptrend. So it started from this point. It made a higher high. Okay, the highest point of a high. A high is the market trending up. There was a slight retracement. This was a higher low. It is a low because it is still on a market that is high. So it is a higher low. Now it went up again. It took out the previous higher high, but then it came down as usual to form a higher low with the previous higher low. Now this leg took out the previous higher highs to form a new higher high, and then there was another higher low. Then this one took out the previous higher high, and this came down to form another higher low. Then this took out the previous higher high to form a new higher low, then another higher high with a new lower low, higher low. All right, so at this point it stopped going higher high again, and the market was almost in a neutral position and until there was a break at this point. So that is all about higher high. A trendy market or a market that is trending up is a high. When it goes up, it's a higher high. When it makes small retracements, it's a higher low. When it goes up again, it takes out the previous higher high, and then when it comes out, it's a lower low. And then when it goes up again, it takes out the previous higher high. That is a sign that market is actually trending up because it keeps taking out previous higher highs. When it stops taking out previous higher highs, then we can say that market is trending down. So that is for the market that is trending up. Now let's look at a market that is trending down in the case of this one uh, right here. Okay, this does not look too much. Okay, let's draw it to this point if we can. So the narrative is actually the same for this one too. It's just like the opposite of what I explained for AI. A market that is bearish is a lower market. Market is generally lower. The outlook is lower. So it can either form a lower high or lower low. Now the lower high, the high there does not mean market is up. The first word is the most important one, lower high. That means it is still low, but it is high, the highest point of the high. So market started trending down from here because this was the lowest low of the previous market structure. Okay, market was trending up, remember, and then this point broke out. So we call this the leg that broke through market structure. Is a leg that broke through market structure. So this leg just took out the previous lower lows, and we know that market is about to trend downward. Now, some of you might be wondering that okay, why did we say this is the leg that took out market structure? Because market could have continued up at those points. Okay, market could have continued up at this point because at this point, nothing has taken out the previous lower lows. This was still a low, a low, a low, a low, and a low of the previous higher highs and lows. Okay, so we don't know market could have continued in this direction, but this leg just took out all these lows and then it came down. So we can call this the leg that just broke through market structure. Okay, so like I did for the eyes, for the IS. So when it came down to this point, this was a lower high, a lower low rather, and then it went up. Okay, and then it retraced again to this point. It retraced to this point, and then it went up. So it kept forming lower highs and lower lows too. But at this point, it looked as though market everything was still on this one range until it came down to break the market lower. Okay, so it went up again to form another one, but it was still within this range. And then ultimately, price was bouncing within this range. It was bouncing. So a lot of you might be thinking, that, okay, you think price is trending up. Price is not trending up at this point at all because it is yet to take out this point. This is the okay. This is the highest point of this market at this place. So until price takes out this point, let me draw a line so we can get it. Until price takes out this point, market is not trending up yet. Or until price takes out this point. So until price takes out this either of these 2 points, market is not trending up yet. Okay. So as you can see, market kept on going down and it kept forming lower lows and lower highs. So there was still lower low here, it went up, lower lows here, it went up. So it started changing, and at this point this was the lower low, and this lower low was taken out. This lower low and lower highs, they were taken out with this leg that just broke out through the market structure. So this changed the market structure for a while depending on the type of trader that you are. This was an uptrend, a momentary uptrend. On the bigger scale, you might not call it a uptrend, though it still looks like a retracement. But if you want, you can call this a momentary uptrend if you want. I won't actually. So, and at this point, market took out everything. It took out these 2 points and it looked as though market was trending up, and we have what we see right here. Now, this knowledge of lower high and lower low is very fundamental because it could help you to draw your Fibonacci very well. I mentioned something earlier. I said a leg that broke through market structure. If you've not forgotten, this was the, let me drop that again so we get, when it was on an uptrend. Okay, when it was on an uptrend, this was the lowest point of the eye. So it is this leg that broke through market structure. This is where you start drawing your Fibonacci from. Okay, so you draw your Fibonacci from this level. Now, what many people do is to draw their Fibonacci from this level. You can't draw it from this level because you don't know whether the market wanted to keep on going down or keep going up, because this was still at the zone of the lower high, sorry, higher low. Okay, it was still at the point of the higher low. So if I want to draw my Fibonacci now, I'll bring it out, and then I will draw my Fibonacci from those points up onto this point. Okay, so I'll draw my Fibonacci up onto this point. Now, if you understand the concept of higher high and higher lows, lower highs and lower lows, let me go on to explain the sweet spots on this line. So this is the 100%. This is another like 100%. This is where you start from. This is where you end. So these 2 points are not really important for your entry. You don't enter at these 2 points. Instead, you get out at those 2 points. Once price is breaking through this point, you know that your fib that you drew is already invalid, at least for that moment. You may respect it in the future, but for that moment, momentarily, it is invalid. So this 38 point, okay, the sweet point for retracement is actually the 70 and the 61. All right. So once price gets to this 70, most of the time it retraces back down. Once price gets to this 61, it retraces back down. But the 28 and 20, the 38 and 23 are best used for scalping. If you know how to scalp, if you are a scalper, you can use these two zones for scalping. Now, if you notice, when price got here, when it got to this 28, it came back down. It got here, when it got to this 28, it came back down, and then it went back before it broke it ultimately. And then price was still respecting this 28. So this 28 points are best for scalping if you are a scalper. But for general trading, you should look to enter your trade at this point of 70 or at this point of 61, either of the two. If you are someone that opens multiple positions, you can enter half of your position at 61 and then you enter another one at this 70 if you want. Now remember, I said no indicator analysis is foolproof or 100%. That means it is possible for price to get to your 70 and your 61 zone and break through your Fibonacci. Okay, it is not uncommon, it's something that is possible and that happens a lot. So if you got to this point now, you can decide to extend this. Okay, you can decide to extend this here. Sorry, excuse me. Okay, you can decide to extend this here, and okay, this almost got to our 61, but it did not quite get to the 61. So if you entered at this point, that is not really, you didn't wait for the 61 to get triggered. So this is not a valid entry point. But if you bring it up to this point, okay, you would see price hit the 61 and then send price down. Now, when you enter at those points, you would want to take your first profit at this place because this is another major support. Remember, I said the lines are support and resistance area. So, if price leaves this place, you would want to take your next profit at this place, and you want to take your last profit at this place. So, as you can see, it sends price up and then it kept bouncing within the 23 and the 38 zone. So that's just the general idea. In the next video, I will take an example, just a trade example, to show you how to use Fibonacci on any time frame. You can use the Fibonacci retracement on any time frame that you want. It is not limited to one time frame. It's not limited to a specific hour of the day. You can actually use Fibonacci on any time frame that you want.